Hey, this is Jeffrey Scott. This is my weekend market update, part two, stocks to watch. Um, for the full in-depth market review, please check the one I posted yesterday, although there will be some repetition here. I won't go as in depth on the market as I did in the first one. I titled this weekend that we got the rate cut we expected. Now comes the PCE and multiple Fed speakers. I'm not kidding. Thursday is PCE. I believe jobless claims might be Wednesday or Thursday. And there's like more than 12 different Fed speakers this week. The market really took off with Powell speaking. Doesn't always happen. Although it was initially weak, Friday showed us what could happen, or Thursday rather, shows what could happen if the market thinks that the Fed is easing. I think there's still countercurrents. I think that there's still potentially um, tightening on the QE side. And so it's not as simple as it seems. And will we lose some of this dovish luster with those Fed speakers? We'll have to see. Again, my name is Jeffrey Scott, marketmripro@gmail.com, Google Group top-down trader. Warning, I am going to review my statistics for year to date. I just want to make sure people saw them. I don't do it often. I did it in July and give you some feedback of how the market's been treating me and really emphasize the power of growth stock investing married to a top-down approach. As always, this is for educational purposes only. Anything I talk about should be taken in the spirit of education and not investment advice. The intent of the video is to demonstrate my tools for top-down analysis and how I apply them. Trading involves risk. You are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky. You should always consult with your financial advisor before making trades. I have another disclaimer after I show you my performance. Always take financial performance that someone does on the web with a grain of salt. Many of you are long-term followers. Many of you have been to my live meetings. You don't know that I'm only showing you my good account. This is the account I do trading. It's the same account we talked about in July. But again, just like I would tell you for anybody else, have a reasonable doubt in anything that someone shares with you online. For continued interaction, think about joining our Google group. It's called Top Down Trader. It's free. You get discounts on my tools and you get some educational opportunities that I don't do widespread. Sign into Google Groups, click all groups and find the group you want to join the group, and then you'll be part of our family. I have my live meeting coming up October 26th and 27th. It'll be at the Marriott Palm Beach Gardens, 2 packed days of education and software instruction. 1250 includes breakfast, lunch on Sunday and Monday with dinner on Sunday night on me. Hotel will be at the full service Marriott, 155 a night. If you really want to get educated, come and spend more time and come to the John Person Seminar, which is October 24th and 25th, immediately before my meeting. Separate fee for each, but only takes one airfare to come and go. If you attend my meeting, you get a $4 rebate towards purchase of any of my tools. If, for example, you are a top-down trader group member, which you would be if you're buying something, you would get that $400 rebate plus the $100 in top-down trader against the $19.95 retail price of Market MRI Pro, which would cut it down $500. If you own additional tools of mine and you attend the meeting, you get even more of a discount. And you don't have to wait to the meeting to get your tools. If you pay the $12.50, the rebate's immediately available to you. If you're interested, just email me, Jeffrey Scott at marketmripro@gmail.com. What I'll teach you in Florida, I'll set the foundation. I'll probably do a web session before for the new people. Tools from the masters I've learned in over 30 years of trading markets, and then how to master a top-down approach yourself. Tools for market timing, when to be in and out. How to identify the best sector and industry groups. Tools and techniques to identify the best stocks at a given time. And then how to use options to multiply your performance. When you see my performance this year, it's pretty massive. I couldn't have been there without options. Money management skills, start with what to buy, where, when to buy it, how much to buy, and what are your stops and targets. If you don't know all that information before you make a trade, you're going to lose money. And then add some special sauce, seasonality, And we'll talk a lot about relative strength, which is really the core essence of how I trade. And then how to master the tools, whether you have my tools in TradingView, TradeStation, or you have my Market MRI Pro app, whether you have the CAT scanner and wealth charts. And by the time we do the meeting, maybe you'll even have it in Metastock. So, old slide, and I bring it back to emphasize why top-down trading. If you take smart people, put them in the same room every month, and keep track of their stock picks, and then retrospectively assign what the market was doing at the time. Strong market, mixed strong, mixed weak, or weak market, and then look at the performance over the next 20 or 40 days. You could see what happens. Well, 20 days is 1 month, assume 40 is 2. In a strong market, good pickers, stock pickers, could double in 1 month. Hard to believe. Not really. In a up market, but not as strong, you can almost double in a month. Now look at what happens in those two as you go from 1 month to 2 months. There's a reversion to the mean. So the message there is simple. Take some profits after you get a big move. On the bottom, whether it's a mixed week or a weak market, excellent stock pickers that generated 100% monthly returns above had significant losses. And unlike the reversion to the mean seen in a strong market, in a bear market, which is a very weak market, things will get worse. So there's no reason to hold on to anything unless you've got really good reason to. So let's talk about my trading in 2025. When I've done my educational programs historically, I want to prove my system works, but I've never shared my account. Rather, I've showed some of the stocks that I've talked about, typically on some of the videos that I've done, and I proved the techniques by showing you specific chart patterns and outcomes. This year, I decided to share a model account. No, I don't share it like you're paying me a service and I put it up every week. That's for my paying members, which there are none. So I started with a model account of 150,000. I trade predominantly options. I will teach you how to ride options up and out in your leaders. I've used the same tool that I'm going to use tonight, Market MRI Pro, to find the best stocks in the best industries. In July, I showed people my brokerage account with a double of the account, up to like 158 plus in the first half of the year. And then I told you that for the rest of the year, I wanted to see if I could double it again, including an additional 500,000 that I added. So here is what happened next. If you look at my account, my model account, and this is Charles Schwab, this is how they do performance. And you know what? It's easy and it's clear. This is my equity curve. And my equity curve, since the bottom of the market in April, has gone pretty significantly higher. In fact, cumulatively from January, I'm up 188%. Now, I'm not perfect. I had a strong January and February, but I took some heat in the March and April sell-off. And just as it seemed like the market was going to hurt me, the market turned around. You could see my starting equity was $149,821. Here's the 503,000. 500 was the money I put in July. 3 was because I had a margin call, little margin call, when I pulled back some. Here's my investment change to date. So I'm up 549,000. And you could see that's where you get the 188.16. Now, let's think about this slide here. We had a significant bottom. How do I know? And how can I prove it? Because I shared a video with you on April 7th saying a bottom is in. Didn't know if it was the bottom, but a bottom was in. And I told you I was buying Palantir, I was buying Hood, PAGs, which didn't do as well. And here's what happens when you trade with an effective trading style, buying the best stocks in the best industry groups when the market turns around. Between April 8th and September 19th, my account is up $611,000 and a percentage return, cumulative rate of return of 389%. Top-down investing works, and you want to make sure when you are at those major turning points, March 9th of 2009, so we're in the late March of 2020, and now April 7th of 2025 are the three last major turns that I participated in. And those, by the way, are the three biggest return years in my career, percentage-wise. Disclaimer, past performances do not always predict the future. Results are in my main trading account alone does not reflect performance in my longer-term managed and unmanaged accounts. My biggest part of my wealth, as I tell people, is managed by wealth managers. Why? Because someday I'm going to die. And if my wife is still living, I want her to continue to get a monthly check to pay for everything that she needs. She doesn't care about trading. She doesn't want to be doing that. So the wealth managers are there to make sure that when I'm gone, things will be taken care of. I also want to be clear that I look at my trading account as my risk money, and I don't want to spend my entire savings and benefits from selling companies and putting it at high risk. Trading options is still risky and should not be done without adequate education, and I trade options. And trading performance is much more than it would have been purely if I was picking stocks. Again, if you want to see exactly how I do it, and for me to teach you the tools and how I approach the market so you can do it yourself, I used to call my education be your own guru. As Ian Woodward used to say, I'm not a guru. He wasn't a guru. We want to teach you to be your own guru. And now on to the charts. All right, kill that. Just to remind everybody, the Qs led the market on Friday up 0.68, Spider 0.22, Diamonds 0.06, and the Russell was down 0.78. However, I like to look at the 5-day return, and you can see the Qs were up over 2, Russell almost 2, Spider 1, and the Diamonds lagged. It was a pretty good week with improving breadth in the market. Friday, not so much on the breadth. When you look at what worked over the 5 days, and I like to look at 5 days on the weekend, you can see technology, communications, discretionary, and industrial are all up 1%. And the big losers were real estate, staples, materials, utilities, and healthcare, except for materials, the more defensive parts of the market. And if we look at what's really working on a 5-day change, uranium, clean tech, autonomous vehicles, cannabis, batteries, metals, and mining. And if we want to look at what was working on the 1 day, and I think that's important because there was a clear theme. Uranium, gold, silver, gold, silver, gold, silver. Everywhere I looked, the gold and silver stocks, not only do they look like your OKLO with huge moves, they actually got earnings, and some of them have pretty impressive earnings growth. Bitcoin was the one thing to take it on the heat this week, down 1.52, and volatility was down. When I say breadth wasn't great on Friday, you could see only 25% of the S&P 1500, 35% of the NASDAQ, and 30% of the NYSE was up. So if we look at the timing model, here's the daily, everything's in a buy, same on the weekly and monthly, let's move on. If we look at the indexes, we are going to get a correction. Whether we get it this week because of the weakened seasonality and what the Fed had speak, no markets go up forever. But we are in beautiful patterns on everything. All four of the majors, the Spiders, Qs, Diamonds, and Russell, hit all-time highs this week. Think of that. The Russell joined the party, called it Russell Mania. Now, the Russell gave a pretty hard reversal on Friday. I have to see what it does. What makes me bullish, even with a correction, is we've got the 17 and the 50s right underneath each of these. And when you look at the 50, it's not much more than 5%, 6%. So I do think we end the year higher than we are now, but I would not be surprised in the meantime to see a shallow correction. Do I think this market's going to break and fall all the way back to the 200? No. Could happen. I don't think so. Volatility actually came down on Friday, as you can see here. And if we look at the week on volatility and the dollar, it'll tell us a little bit of a story. And you can see on the week, get this, sorry about that. My mouse is so picky. Let's just look at 30 days, 30 weeks. You can see on the week, the VIX kind of a spinning bottom. That was at the top. We call it a spinning top. And it was up almost 5%. And the dollar really looks like it's bottomed, doesn't it? Big bottoming candle closed at the high of the week. So those are two things that might be concerning. Now, once you get out past the next couple of days, October is not typically a bad month in the US markets. In fact, it's a good month. And then November and December are the best. Just October has had a couple of big corrections in it. On the commodities front, the place to be has been gold and silver. And you can see they had huge moves on Friday. Oil bouncing around the 50 and natural gas still breaking down. The other thing to potentially be concerned about, let's throw weeklies back on the 10-year and the 30, is both of them look like reversals. Closing at the high of the week, up 1.92 and 2.05. You could see the bottoming tail. And I think that the dollar and rates could pressure the US markets. And that's why I think we could have a shallow correction coming up. Now, as long as we stay below this 5% range, I'm not going to be too worried about the rates. The buckets tell me that the markets are not extended to either way, so that's neutral. And the market breadth didn't give us any major signals, but it did show very high volume. It was an options expiration. But notice with all-time highs and just off the all-time closing highs, that the stocks above the various moving averages came down. In fact, if we look at the new high, new low 13-week, you could see that the 13-week new highs are down, the stocks above moving averages are down, and for the most part, the AD lines are pointing down despite all-time highs. So my summary that I made the other day was, I bet we go higher. It wouldn't surprise me if there was a short-term pullback, and those divergences in the market have to be noted. So we went through the top-down approach, and just to review, when we look at the top-down, we have all the sectors. You can just look at percentage return. Now, this will look different than what you saw before because this is a list of over 4,000 stocks this weekend that are packed into their sectors and industry groups. Sometimes to take away some of the day-to-day, I'll look at what's called the two-day momentum, and it was utilities, technology, and communications. And when we talk utilities, we're talking about the things that are powering data centers. The electric producers are hot as can be. You could also look at the individual sectors and look at what sectors were moving the most this week. And on Friday, uranium, industrial, real estate, more precious metals, silver, and gold. That kind of gives you a sense of what we're going to see. Now, regulated electric, these are some of the things that are in the that are driving the markets. And if you look at some things like ACLO, which remember we talked about ACLO? When did I tell you about ACLO, folks? I think I told you about ACLO on this candle here. And why? Because it had the blue dots coming in. That's a person buy signal, which I probably wasn't showing you, but that's where I entered it. It's now 135.32. The thing that's scary is when you look at the fundamentals of ACLO financials, it has never made money. And if you look at its revenue, it has no revenue. Its net income is losing a lot of money per share. Yet the stock is priced to infinity. It feels like meme stock mania. It doesn't mean that I'm not in it. It doesn't mean that I'm not loving it. It means I'm not that confident in it. But those are the reason why the stocks are up. But there are a number of electric producers that are breaking out here. And a lot of the discussion is because these are likely related to powering data centers. So that's what was leading the market. And then the other thing is gold. And just to show you, this is a long list of gold stocks ranked by percentage return. there's like 10 that were negative and the rest are positive. It's crazy. Whoops, let me take out the others. Hold on, regular electric. There's the gold. There's only 4 negative and a large number of positive. And probably two of my favorites were Goldfields International, and we'll talk about one of the others in a few minutes. So let me show you some of the stocks that I thought were ones that I'll be watching closely this week. Again, the market dictates everything, but Palantir, which many of you probably already own, but it had a recent pullback. It's got strong seasonality. And when I looked at the daily chart, I was impressed that it's breaking back out. You might want to wait for it to clear 190, but I think if it break out above the current price, I might be interested. And notice here that after the relative strength has been negative, it is now trending positive again versus the spider, and the OBV just turned up. Expensive stock, defense contractor. If you look at the fundamentals, you could see that it makes money, although it doesn't make a lot of money. Its earnings per share growth rate is picking up. Its revenue change is pretty strong. It does not pay a dividend. It does have a very high forward PE, which is why people don't like it. I do like the company. I like the story, and maybe it's giving us an opportunity. Obviously, it would have been better a couple of days ago. Probably a little bit of a risky because it's had a big run. Dave is a technology play it does financial software. And let's put a weekly so we can see what it looks like on the weekly. This is one that is multiple stages. So here's probably your first stage, second stage breakout, third stage breakout. On the weekly, it's creating a flag here. And if we drive it down to the daily, I kind of like this pattern here. And if we break out here, certainly draw this line across here and think that we're probably breaking out. So another one that I like, and again, when I like to look at fundamentals and look at these earnings per share growths, this is what I like even more than I like the stock price. It's got a multiple of 28. It's got a growth rate of the last time around of 210%. It's going to slow down. The prediction is $2.09 for November, which compares to $1.51. So that's a 30% growth rate still. And look at all the surprises it's been having. So one would expect a surprise. And if you look at revenue change, it's had great revenue growth, great surprises. I think fundamentally that one looks really exciting. And I think it's at a decent buy point. The old name, not an old story, Netflix. I wouldn't buy it yet, but I'll be putting it on my watch list. Why? Because it's sitting right at free parking, which is the 50-day moving average. And I might be waiting for it to break. Whoops, I didn't mean to kill both. Let me try this again. I might be waiting for it to break above that trend line. What I like about Netflix is seasonality, and you can see that it's got some really strong seasonality coming in here in October. So if I was to buy option trades, I'd want to look at where their October earnings is because it certainly looks pretty interesting. Let's do a deep dive into it. It may take too long on slow internet to show you, but this is showing me 5, 10, and 15-year seasonality, which is really strong as we go into October. So Netflix is another one that I'll be watching, and I love buying things when they pull back. Let's see. Speaking of pullbacks, it's not necessarily giving me a buy signal yet, but GEV is one that has really behaved well. Let's go on to a weekly. That's pretty well. And here was a big pullback, and here's your next pullback. So the question is, will this do the same thing? I like where it's sitting on the 50, and I'd be looking at what happens with GEV. And you can see I'm a sucker for earnings. Here's another stock, double-digit PE. It's high, but look at the earnings per share growth rate. Revenue is growing, although not as fast. $1.76 is going to be compared to 35 cents. That's a 300 or 400%, 500% growth rate. I think GEV is about to take another leg up. I like GEV. Two more, maybe three more. There's a lot of stocks I like this week. Microsoft. I bought some early in the week, and I was glad I did as it ended the week strong. I think Microsoft is also one that's breaking out here. Look at the volume, CPR volume breakout momentum coming out of a squeeze. Relative strength and OBV are turning up. I think Microsoft looks very interesting here. And then everybody's heard of Fix, and Fix has a big role in working with data centers on air conditioning. It's kind of an expensive stock. Is this a cheap fix? It's in the same industry group. TGEN is a cheapy one, and it's given us a nice breakout opportunity from the 50 with volume breakout and momentum with relative strength and OBV turning up. And then for earnings jockey or for dividend jockeys, I don't know anything about Trinity Capital, and I don't know if it's a good company or a bad company. And let's see if it shows the same thing here that it showed in a different source. It pays a 13% dividend. Its earnings are consistent. Its revenue is not as consistent. It has a very small multiple, but if you're into dividends, it might be worth checking to see how stable that dividend has been. So those are some of the ones that I'll be watching. Let me pick one of them to show you a little bit how I might manage. And let's talk about Microsoft. And the way I trade, and it's important to understand the way that I trade. I look at a pattern, and if I didn't have this bar, then this was the highest bar since, and I connect this with that bar, and I would have said, I break out above that, I want to enter. Okay. And this is a breakout. I like this. Now, the way that I trade is I want to buy high to go higher. So I don't want to wait for the stock to pull back because that'll kind of kill the story. So I would look at where it closed, and the close on this bar was 517.93. And I'd probably put a buy stop, is sort of in the, wait, it's not 517, is it? Doesn't look like 517. High was 519. So I'd probably put a buy stop just above where it closed. And I like to enter stocks with a buy stop. And the reason for that is if the market opens up Monday and I'm not able to follow the market because, hey, I'm working, I want to know that I didn't get filled because you had to trade up to fill me. And if the futures are down 300 points in the morning, it's probably very unlikely that the market traded up. I also want to set my stop, and I'll look back, and there's lots of things that I would do. I can see a couple of reasonable stops. One would be right here, which would be the low of this candle because this broke the 50. And if it goes back below that, it means it violated the 50. I could look at the 50 itself, that if it trades below the 50, then that is a violation. And sometimes I'll look at the last 4 bars, and this one's the lowest, and that's at 505.93. So let's just talk about each stop. If I don't want to get stopped out, I'll probably look at this 505.93 and set it like 505.70. So I'm looking at 520. That's not where I'm going to be. Let me go back here. Let's play a little with this candle here. The high on this candle is 519.30. So I want to get down to 519. That's good enough. That's 520. 519.62 is that price. This one is at about 505. So that means I'm risking $4. I am setting my stop at the lowest of the 4 bars, 1, 2, 3, 4. And if it trades below that, I'll be stopped out and the product will be sold. I do that because now I can say I want at least a 1 times R target. Maybe the target will be up here somewhere. And the way I trade, and I'm definitely in for the rest of this year, and my posture is going to be to protect what I've done so far, is I would like to have the stock, do something like this. Okay. And I would take part of my position off here. And then the next thing that I do is I would raise my stop to break even. So I like to set a target, take a third off, half off, whatever is your poison, and raise your stop. Because now you can't lose money on that trade unless it gaps against you. I do the same thing. I look at the chart, whether I'm trading options or stock. On a $520 stock, I don't care how much money you have. Even with what's in that account right now, I can't buy 1,000 shares. It would be too big part of that portfolio. So I will probably look at calls. And if you want to know which call, come to my October meeting and I'll show you how I go through. Is it a married put? Is it a bullish call or call spread? Is it a broken wing butterfly? Is it a synthetic or a chicken shit synthetic? I go through each of them and why I picked them. I like Microsoft. I think that'll be interesting to see what we get this week. I am a little concerned about those Fed speakers and why I set a buy price above the current prices. Again, the market has to go up typically for me to be filled. Right now, the futures are down a bit, but not really much of a big deal. Gold's up another 17 points. I did tell you there's a gold play I wanted to show you, and that gold play is Kinross. And I think there's a number of them that one could choose. And let's find it here. Oops. And I like the little hiccup it's have. But again, I like fundamentals. And if I go over here, projecting 32 cents versus 24. So that's 33% growth. That's if there's no surprise. Look at the surprises, look at the revenue. There's no way that gold at current values are priced into these numbers. That's why they have the big surprises. Has an 18 forward PE and a growth rate of 200. I like KGC, but to be fair, there's a lot of beautiful ones. And again, we already talked about GFI, not Giphy, beautiful chart. You could look at one of the big ones like Newmont. I think you have to have gold in your portfolio. I've got stocks. And then for those that have followed me for any length of time, they know what I did with gold. And there were a couple buys I had on gold, but this one came off. But I did a whole video talking about gold and the multiple tops and finally breaking out. And gold's had a great run. Hope you like these videos. Give me some comments. Come to my live meeting. You want me to keep doing these? It's good to know that people like them. I do this to help people. And the live meetings are a lot of fun. You may ask, why do I charge? Because it costs me money. And I haven't had a live meeting that I made money because I don't want to make money. I just don't want to be funding the meeting and having a loss. So we'll see you soon. And I have a good rest of the weekend.